Only a sucker would buy Tesla, they said in 2019. But what if they were wrong? Welcome to My Tesla Weekend. I get a lot of comments about how I should buy more shares if I'm so confident in Tesla, and I agree, I should, and I plan to. These skeptics, critics, doubters, and otherwise ill-informed haters are nothing new, certainly not anything new to Tesla. I've been following the stock for years, since well before it was elevated to the level of STONK, whatever that means. When I bought in the famous dip of 2019, I was so proud and so excited I shared my good fortune with friends who were, to put it mildly, not impressed. They said it was too risky, too likely to fail, and considering the fact that no American auto startup had survived since our grandparents were born, surely this would fall to the very same wayside. Not sure how that phrase works exactly, but just like Tesla, it did, and you got what I meant, so here we are. Now, I could cherry pick some numbers to make this scenario look ridiculous, but instead, let's go back to January 1st of 2019. Simpler times. You could go outside without looking like a bank robber in a mask, and handshakes were still a thing. I don't miss them, if I'm being honest. The handshakes, not the bank robbers. I do miss those guys. So let's say it's January of 2019, and you, Darren, your big goal in life is to buy the cheapest base model car you can find and pay it off in 2 years. The cheapest one I could find was a 2019 Nissan Versa at $13,255, which, after tax and all the madness, is going to be around $16,000. So your monthly payments will be about $680 if you're going for a 2-year term and you get good rates, but you're a smart, frugal, and an aggressive saver, so this should be no problem for you. But your car still has some life left in it. So instead, you commit to buy just one share of Tesla on the first trading day of every month. Not the best day, not the lowest or the highest, but the first trading day of every month. You can always sell the stock if your car dies, so let's do this thing. Let's roll the dice on Tesla. January of 2019, you buy one share for $306, and you're pretty excited. But it doesn't do much, and come February, it's about the same, down just a hair. Losing 0.2% in a month isn't bad. Maybe this is a buying opportunity. Your car still works, so you buy a second share of Tesla as planned. When February rolls around, you're finally up, but only by a single dollar on a $614 investment. No matter, you weren't so much gambling as investing, and it takes money to make money, you say to yourself, as you buy a third share. March ends in the red, and you can't pretend you're having fun. Why keep the old clunker if putting cash into innovation leads to 5% losses? Maybe you should just call it a day and just get what cash you can back before it's too late. But you don't. You buy one more share at the lowest price you've ever paid. April 1st makes quite the fool of you, as it's been your worst month in the stock yet, down 15% overall. Your $1,135 is now worth just $955, and that confidence you had isn't feeling quite so great. But you buy another share, just the one, and it's again the cheapest one you've bought to date. May is brutal, and your investment is down even further. If this hypothetical is to get back into the green, it needs to do it right quick. Despite adding a share last month, your portfolio is worth less than it was before that. But still, you add one more share. June starts off as a bloodbath, with the stock seemingly in freefall at the end of May, and you tell yourself you'll give it just one more month before you jump ship and maybe buy a used car instead. July is kinder, with the stock climbing on solid delivery numbers, handily beating the Wall Street estimates. Half the losses you endured have already gone away, and since your old ride isn't quite dead yet, you again buy one more share, hoping to get back to square one. August starts off so strong that you gladly buy another share, but by the end of the month, you're back to being down 11% overall. This is a wild ride, and not for the faint of heart, but you stick with it. September's weak start convinces you maybe it's time to exit the stock. But during the month, you get closer to breaking even than ever, so of course you add one more share. After all, these are essentially car payments you're putting in. Some find it tough to buy shares when it's at an all-time high, and others find it hard when it's falling. There is no best time to buy a stock, barring your access to time travel, so the point of this exercise is to say that time in the market beats timing the market. And here's where it gets interesting. But first, spare me 3 seconds to thank my Patreons who get bonus content, a closer look at my math, and behind-the-scenes content for as little as $1 a month. I'll spare you the narrative of the following 14 months and just say that this was the lowest percentage gain in the story through the end of 2020. And in August, the stock split 5-for-1, bringing your share count to date to 100 shares. Even with the assorted health, economic, political, and other crises, and despite always adding more and usually at record high levels, the 24-month experiment ends with a total investment of $14,838 turning into $71,932. That's through today, not even the end of January. So imaginary Darren can finally buy that Nissan he wanted and pay cash if he'd like. He could even buy a nicely appointed Porsche, Mercedes-Benz, or more likely, a Tesla. But he's not going to do that. If he sees the factories about to come online, the customer and brand loyalty, the steady stream of innovation, the embarrassing struggles faced by so-called bigger, better car companies as they try to break into the EV space, he's not going to sell a single share unless he has to. If you've ever seen Solving the Money Problem, Stephen Mark Ryan is the kind of investor I'm describing. He could buy half my neighborhood if he sold his shares, but he knows better. If he was that kind of investor, he'd have cashed out long ago, or more likely, never invested in the first place. This also describes me. This describes a lot of Tesla investors, and those of us who got in early, which is most of us, we can lose 30%, 50%, 80% and still come out ahead. If you aren't subscribed to him, maybe you should be, because his tune hasn't changed since he started, and he's seldom wrong. For that matter, you should subscribe to me, since it's the only way YouTube knows this is the sort of video you're interested in. I'm no investment advisor. I can only speak to my own experience. If Tesla 4X's tomorrow, I'm not selling. If it 10X's in a year, I'm still not selling. Until Tesla exits the growth phase and becomes a dividend-paying, dead-end company, I'm not selling. This is the new Dutch East India Company, and it's just getting started. And while even that reached its zenith and began to fall eventually, you'd have to be a special kind of short-sighted to jump ship now. So let's hear it. Where do you think the stock will be at the end of 2021, 2025, and 2030? Stay tuned, stay juicy, and I can't wait to hear from you clever robots on Mars, though preferably not on impact.